All right, guys, bang, bang. I've got Darius here. Darius, Janet Yellen, the Treasury Secretary, recently gave an interview and she was asked how herself and President Biden think about inflation. And one of her components of the answer was a classic talking point from a politician or a government official, which was, yes, there are some prices of important goods that has gone up, but people are better off. Wages have gone up. And so the American people are better off than they were pre-pandemic. What do you think? Do you agree with her, disagree with her? Maybe there's nuance here.
Well, maybe so. It's great to see you, man. Thanks for having me back on. I'll say this probably needs to be a little bit of shrinkflation applied to her statement, her commentary, because it is obviously, just judging by the polls, obviously President Biden is polling poorly against President Trump, former President Trump, in head-to-head polls. That her comment is nonsensical. The average American consumer, when you look at the levels of various consumer confidence readings, are very depressed cyclically. They're moving higher, so that's been supportive of asset markets. This Goldilocks regime we've been calling for since early November, but that's neither here nor there. What really matters for the consumer is the perspective of cumulative price inflation. And if you think about cumulative price inflation, particularly for people on the lower end of the income spectrum, they've been down on a net basis on real income terms over the past few years. The people in the upper echelons of the income and wealth distribution spectrum have done quite well. Things like net worth, household net worth, cash on household balance sheets, those types of statistics have broadly outpaced inflation since the start of the pandemic, really since the start of the fiscal and monetary largesse we've seen really since early 2020. But if you think about things like just wage inflation, particularly again for those lower to medium income consumers, it hasn't been great from that perspective. So would disagree with her comment, but I don't know that I would agree with the other side of her comment, which is this is obviously bad because, again, from a distributional standpoint, there are winners and there are losers.
Yeah, it's interesting because from pretty much when Biden stepped into office for like 22 or 24 months, I forget the exact number, negative real wage growth was the theme. Like it was almost like this guy's undefeated when it comes to real wage growth. He just throws up red negative numbers every single month, month after month for like 2 years. And again, some of it is because of his policy. Some of it is because of Trump's policies. And some of it is just the macro economy. It didn't matter who was president, but there was
Oh,
just this like undefeated run of negative real wage growth. And then
yeah.
it flipped and he went 7 months in a row and it was positive. But then we just hit back and now we're negative again based on the January kind of reacceleration of inflation. And so part of this also is like, well, it's kind of been mixed. Like there's been times where wages have been gaining on inflation. And then there's been times, again, like 2 years where wages weren't. And so you can kind of pick and choose your start and stop points and manipulate the data in a way that tells the story that you kind of want, which seems like maybe that's something that, both parties would love to do going into an election year.
Yeah, walking to political science 101. Which data sets that best tell your narrative? I mean, and that's kind of what this is, right? We all know it's a parlor game. It's designed to get the elites paid and in the right positions to take advantage of the rest of us. But it is what it is. I don't know that going back to one of my favorite statistics I throw out in terms of why we are here from the perspective of well above trend inflation for several years, why the economy, partially why the economy has been resilient, much more so than the average investors expected, is when you go back and you look at the fiscal monetary policy response to the pandemic, which is obviously extreme. We grew the federal debt by $6 trillion in the 2 years ending in 2021. So 2020 to 2021. The Fed monetized over 50% of that. And that $6 trillion was spread out evenly in 2020 and 2021 with Trump and Biden as presidents. So this is something we've long argued, even for years, even going back to the early days of the Trump presidency, is that you need to, as an investor, kind of shed your old school thinking of between Democrats and Republicans. The reality is it's populist and more populist in terms of how monetary and fiscal policy has evolved here in the U.S. And really, this is not a U.S. phenomenon. This is something that is being driven by the fourth turning, which many of you guys know. My former colleague Know-How, one of my mentors, his work has really helped us understand some of the political dynamics and social economic dynamics that are causing that shift towards populism and increasingly towards populism for certain pockets of these political parties. And so, in our opinion, it ain't going anywhere. It's only going to get more populous, more fiscal and monetary largesse in response to crises going forward. And ultimately, there will be a tipping point that we have to deal with as investors and as people in this society. But we're probably not there yet.
So let's talk about this quantitative risk management model that you have, and you guys put together the summary. But basically, there's short term, kind of short to medium term, and then you've got medium term type signals. What are you seeing, and what is these models and risk management frameworks really telling us about how investors should be thinking about their portfolios and the assets that they're allocating to?
Yeah, great question, man. A nice pivot too, because you and I can go for hours, particularly over beers, and we certainly have a lot of experience with that. About some of these longer term fiscal monetary policy dynamics and economic dynamics, and I think I like to think that you and I are two of the best in the world at that, with mincing no words in that statement. But in terms of what we do for our clients at 42 Macro, is more focused on how do we actually make and save money today. What is the medium to long term, sorry, short to medium term outlook for asset markets, and how are we best helping investors position their portfolios to take advantage of market risk up or down, left or right, rain, shine, or sunny? Yeah, and so just a little bit of background about myself. I spent and spend in my career traveling around the world, meeting with institutional investors on the global buy side. I've probably done about 5,000 meetings with CIOs and PMs across the global buy side. And what we're trying to do, the services that we provide to them are what we consider to be macro risk management. And that's a kind of a dirty word for market timing, for factor selection, factor tilting, and all this kind of stuff that institutional investors are tasked with because they are either benchmarked to asset markets, or they're in some sort of market neutral, long short kind of framework that forces them to take certain kinds of risks. And so what we've done for our clients at 42 Macro is build a series of models that are really, really accurate and really, really repeatable in terms of the output that they generate to help investors stay on the right side of market risk. There's a choice you have to make as an investor before we even unpack this slide. You can not stay on the right side of market risk, right? You can be long an asset that is in a drawdown and continuing to draw down because you believe in the long-term thesis. But for institutional investors, they get fired when they do that. They can't feed their families when they do that. So they need to generally be making money all the time, or on their way to making money all the time, because they'll lose their jobs otherwise. And so what our models are designed to do is help investors, kind of maximize upside capture in bull markets and minimize downside capture in bear markets. So with that preamble out of the way, let's just get into this slide. So as you guys can see, this slide is, as you can see, it's dated Thursday, February 15th, 2024. Every day we publish our leadoff morning note, and every Saturday we publish our around the horn. Our quantitative risk management summary is updated and featured in that slide. And what the updates are just the highlighted call outs from each of those various models, which we actually publish the output of the models as well in the presentation, but we don't have time to go through that today. So as you can see, in terms of stuff that I think will be broadly relevant for most market participants, if you look at our positioning model, there's some interesting signals there in the positioning model. The retail trader positioning was extremely overweight stocks heading into this week's correction that has since dissipated. But if you think about equity or investor positioning from the perspective of systematic investors and market neutral players, it's actually suggesting that there's still elevated risk of a correction from the perspective of CTA positioning being extended, from the perspective of market neutral investor positioning being extended. Just skipping down a little bit, we're still, if you look at the medium term signals, which tend to resolve themselves on a 3-month or more time horizon, our global macro risk matrix, which is the primary model we use to keep our clients on the right side of market risk. This is the model that called for Goldilocks going back to November alongside our positioning model, and has really helped our clients, really benefit from this massive bull run we've seen across stocks when a lot of investors are, kind of kicking and screaming, shouting bear poor narratives to the high heavens. But that's neither here nor there. So we're still in Goldilocks. If you kind of scroll back up and look at the volatility adjusted momentum signal, we're starting to see changes in some of the compositions of the defensive assets. We're seeing things like the MOVE index break from bearish VAMs to bullish to neutral VAMs. The currency volatility CVIX break from bearish VAMs to neutral VAMs. Treasury bonds break from bullish to neutral. And so you're starting to see the kind of global currency and global fixed income markets start to price in a little bit more volatility that would be suggestive of moving out of the Goldilocks regime. Now, it's very likely that based on that weather model signals down there, where we're generating the weather models currently generating a bullish 3-month outlook for stocks and bonds and a neutral 3-month outlook for the dollar, commodities, and Bitcoin, that would suggest that we're probably headed for something that looks more like reflation rather than Goldilocks. Reflation is also a risk-on regime, but it's a risk-on regime with an inflationary bias and a bias that is less positive for fixed. It's actually negative, explicitly negative for fixed income, but it continues to be quite positive for things like Bitcoin, things like the stock market. So again, this is something we refresh 6 days a week for our clients at 42 Macro. Obviously, we unpack the callouts as well with all the charts and the data supporting that.
Now, when you start looking at assets like Bitcoin, one of the things that's been really interesting to me is it seems to be serving as like an index for global liquidity. If you look, and as global liquidity increases, Bitcoin's price goes up. Obviously, the opposite happens as well. And we've talked for months now about the Fed, the ECB, and Japan all contracting their balance sheets while China is just bucking the trend, middle finger to the rest of the world and saying, let's pump liquidity into the global system.
Totally.
And so we've seen Bitcoin run up quite a bit in, call it the last year or so. Is this a game of more and more assets will become these like global liquidity indexes? Or do you actually think that legacy kind of traditional assets like the stock market or others, they're not really just dependent? There's too many other fundamentals. There's too many other things that are at play. And so Bitcoin and Bitcoin alone will be that kind of index of global liquidity. Like I don't really know how to think about it yet, but I know that Bitcoin is doing that today. And it's unclear whether this is just the first of many assets that will just become a global liquidity trade, or will these other assets be able to kind of retain some other drivers of, price action, not just, hey, our central banks, green light, red light, and playing a game. This episode is brought to you by Freck. Historically, the wealthy had a hidden secret in investing. They would spend a lot of money and use very big teams to conduct tax loss harvesting. Tax loss harvesting is the timely selling of securities at a loss to offset the amount of capital gains tax owed from selling the profitable assets later. But now Freck is bringing this incredible advantage to any investor. They'll literally lower your tax bill, regardless of how much money you have. They use state-of-the-art technology through a product called direct indexing to allow investors to invest in the S&P 500 while getting all the benefits of tax loss harvesting without the big bill. If you want to learn more, go check them out at freck.com. That's FREC.com. I'm a big fan of the product, and I even became an investor in the business. Freck.com. Go check them out today.
Yeah, no, so that's a great question. So a lot to unpack there. It's the kind of key takeaway, just to answer the main question, which is Bitcoin going to continue to be this sort of being dominated by global liquidity and separate and apart from the rest of asset markets? We would say no. If you go back and you study things like our global liquidity proxy, which for those who may not be familiar, it's the global central bank balance sheet, the aggregated global central bank balance sheet, plus the aggregated broad money supply, plus aggregated global currency reserves, FX reserves minus gold. And when you look at that time series, it's actually highly co-integrated with every asset market, whether it be corporate bonds, treasury bonds, stocks, crypto, every asset market, with the exception of commodities, which tend to be more stationary time series. Any asset market that is a non-stationary time series, which most are, then, with the exception of currencies and commodities, then you're talking about it's going to be highly co-integrated, if not very correlated with fluctuations and the level of global liquidity. So this is something that's been something we've observed for quite a while now. It's become more popular as part of the market discourse amongst broader market participants. But what we've been doing at 42 Macro, and I think we've done a great job at this, is one, help investors understand what are all the moving parts in that liquidity matrix. Which central banks are likely to continue tightening their balance sheet or starting to ease their balance sheet? Which economies are going to have an acceleration or deceleration in credit growth that could be very onerous? Which economies are having positive or negative current account flows that could ultimately be positive or negative for the global liquidity matrix? So for us, I think for a lot of folks who listen to podcasts and watch Twitter, and there's nothing wrong with those things. But I think if you want to consistently stay on the right side of market risk, you need to do a lot more than that as an investment process. And what we do in terms of helping our clients understand these liquidity flows and how they're going to ultimately impact asset markets is actually do the granular research in terms of tracking growth, tracking changes in inflation, tracking changes in policy across all the major economies, particularly here in the US, because obviously US and China tend to be dominant in these liquidity discussions. We understand all those moving parts that cause liquidity to go up or down faster or down slower or up faster or up slower. That's what we're doing at 42 Macro, which gives our clients, a much better, kind of flashlight into this dark future that we're all investing in, on a consistent basis.
Now, when you look at these models, what exactly are people doing differently? And we saw the 60 Minutes interview. The Fed chairman seemed to be quite revealing in his commentary, but maybe they aren't planning to cut by March. It seems like the January inflation data reaccelerating probably pushes it out a little bit further. Is most of your clients changing their portfolios right now, or not really?
No. Well, most of our clients have been benefiting from the bull run. We've had a few legacy holdovers, or not even legacy holdovers. We had a few new clients who've joined us in the past few months, particularly on the pro to pro investor side, which are our high end institutional client relationships that have come on and said, "Hey, look, man, we're sick of getting squeezed. We think there's a better way to invest, and we're checking you guys out." And fortuitously, they found opportunities to get their portfolios right size for the current market environment. Obviously, it's hard going from being very bearish to being bullish, in a short period of time, particularly when markets have been on such a run. But clearly, this is a raging bull market, particularly in crypto and stocks, and it's not something you're going to want to fight as an investor. And quite frankly, if you go to our fundamental research summary, which is slide 3 in today's chart pack, there is no reason to fight this from a growth, inflation, or policy perspective. And there hasn't been a reason since late October, early November, at least according to our research here at 42 Macro. So when we look at what our clients are doing, they're by and large benefiting. They're making money quite a lot, actually. When we think about what the broader investor community is doing, going back to slide 1, that quantitative risk management summary, investors have there was some upside capitulation we saw. Heading into early February, a few weeks ago, not a few weeks ago, 2 weeks ago, we saw retail trader positioning crash to the upside and give us that negative signal in terms of being extremely overweight stocks. We saw realized volatility, which we use as a proxy for the trend in realized volatility, which we use as a proxy for systematic investor positioning. We saw that crash to the downside, which is an indication that their positioning was getting extended and stretched to the upside in the equity market. We saw implied correlations, which is an indication that market neutral players, which are these dominant, kind of multi-platform, multi-manager hedge funds that dominate market turnover. You think about the Citadels of the world, et cetera. Those kinds of firms, that it's been a great environment to take risk for them because implied correlations amongst equity index constituents, and particularly the volatility component of that, have been are at historic lows. In fact, during the 0th percentile of daily data going back to 2006. So that would suggest that these managers on the platforms are actually extending their book size, the assets that they're managing, the leverage that they're investing with is actually at max. And so there is some risk of a correction here still, in our opinion, because a lot of the cohorts of the investor community, global investor community, whether it be retail investor, RIA investors, systematic investors, market neutral players, long only fund managers, some of those cohorts are about as bullish as they possibly can be.
Now, the last question I have for you around kind of implementing this stuff, the information that you all look at, how much of this information is really, we want to identify assets before they move versus we want to be positioned in the right markets. And what I mean by that is like, there's an overarching belief, I think, like investing in the right market is more important than which asset you buy in that market. So emerging markets versus domestic, equities versus, somewhere else. And what I continue to come back to is it feels like a lot of people who look at macro, they've been correct in their analysis of inflation or central bank activities, et cetera. But they are buying kind of more traditional assets versus buying like these new assets. And so now that there's a Bitcoin ETF, let's say that people think there's going to be a reacceleration of inflation. Maybe historically they bought gold because it was easy to buy because they just go buy GLD. Do you see people now saying like, oh, okay, like a Bitcoin ETF provides the opportunity to come to the same conclusion? If inflation is going to be a problem, you want to express the same opinion, like inflation hedge assets will go up, but now they're going to try to buy the thing that's more asymmetric because they just have like more ability to do that?
Yeah, so the quick answer is absolutely. We're obviously seeing from a fund flow perspective, particularly over this past week or so, investors really starting to believe in the viability of the something like Bitcoin. In our opinion, that's only going to continue. I mean, if you go back and we did and I think I've referenced this on our show many times, but we last summer we did a deep dive empirical research study with data going back to the 1800s, 1700s to determine what investors should likely expect from the economy, from policy, and ultimately from asset markets throughout the duration of this fourth turning, which again my former colleague and mentor Neil Howe thinks could extend itself until early 2030s. And the key takeaway is that some of the key takeaways are, which I think have very relevant long-term implications for investors allocating to assets like Bitcoin and or gold, is that you're going to have more inflation. You're going to have much bigger budget debts and deficits than any CBO or Treasury or Jeff Gundlach projection could even potentially imagine. It's going to be way worse because, in a fourth turning, these things tend to explode. And as a function of that, we think we're probably going to see a decent amount of financial repression. We think we're probably going to see a decent amount of currency debasement. And so the demand for these types of assets, in our opinion, over the next 10, 12 years is going to explode higher. Now, it's not going to linearly explode higher. If you think about an asset like Bitcoin, there will be crypto winters to deal with, but that doesn't necessarily mean it's not, it's going to be at a much higher price longer term, between now and the end of that period. So what we do at 42 Macro, going back to our quantitative risk management summary or slide 2, our discretionary risk management overlay, is to help investors, going back to answering your original question, we want to make sure that we are there when the money's to be made. But when there's no money to be made and or there's money to be lost, we're not there. Right. We're using our quantitative risk management tools, particularly trying to identify inflections in trends and momentum in and across asset markets. That's the name of the game if you're trying to make and save money on a consistent basis. If you just want to, buy a unit of Bitcoin or whatever many units of Bitcoin you can afford and cold storage it until 2031, fine. I think if you can do that, and if you can allocate to your target date fund and don't look at your portfolio between now and when you retire, I would highly recommend anyone that can do that from an emotional standpoint, do that. But for the other 99.9% of people that want to actively be involved in their investment future, that want to, that love this thing that we call investing, this social activity that we call investing, and want to know what's happening with liquidity, want to know what's happening with policy, with growth and markets, et cetera, and actually want to trade and actually transact a lot more than they probably should. Firms like ours make sure that those decisions that they're making in terms of transacting in financial markets are better and really consistently a lot better than they otherwise would be without firms like 42 Macro.
Where can we send people to find you on the internet or learn more about 42 Macro?
Yeah, appreciate that, man. Thank you. So 42macro.com, come check us out. I'm on Twitter at DariusDale42. I'm pretty active there and on LinkedIn as well. So appreciate everyone for checking us out. But obviously, if you don't check us out, we appreciate you as well, because we think there's a lot of education that we can provide to the general investing public. Because you and I, we will, I don't want to step on any toes here because you're obviously part of some of these organizations. But I see a lot of folks on, the CNBCs of the world, they're not doing a good service for the broader investing public, and we're here to change that.
I love it. We'll do it again, my friend.
Thank you, brother. Appreciate you.